Hi everyone, Jambo, and welcome to the second edition of the Insight Edge, a podcast by RSM Eastern Africa. Today, we are going to look at the export market and intra-Africa trade as a critical focus of development of this region. And with me, I have with me Jaswinder Bedi,
Thank
who
you.
is commonly known as Jas.
Thank you for having me.
Jas
Yeah.
has a very long CV, but he's elder of the Burning Spear and the Moran of the Burning Spear, two titles accorded to him by the President of Kenya for his contribution to this country. Jas is the MD of Bedi Investments, a family business, and is also director of Fine Spinners Uganda Limited. He is the current chairman of the Kenya Private Sector Alliance, KEPSA, and is also the vice chair of the East Africa Business Council. Jas is also the former chairman of this body that was created to promote exports, which is the Kenya Export Promotion and Branding Agency, KEPROBA. Jas, welcome to this.
Thank you.
Thank you for gracing our invitation.
Thank you, Ashif. Thank you for having me.
Jas, I want to start with a very interesting personal statement you have, okay? And it's really dedicated to transforming the region rather than your personal achievements. And it says, dedicated to transforming Africa's manufacturing industry, driving sustainable growth, and positioning East Africa as global leaders. It further goes to say, making a difference for generations to come. A very powerful statement talking about development of Africa. Tell me what drives this passion and how do you keep that fire in you burning?
Thank you, Ashif, for that very important question. Actually, if you look at Africa as a continent, and if you look at Africa's manufacturing contribution to GDP, you'll actually start seeing the signals. I'll give you an example of Kenya. When I was the chairman of the Kenya Association of Manufacturers in 2010, Kenya's manufacturing contribution to GDP was 11.2%. Today, 2026, Kenya's manufacturing contribution to GDP is 6.7%. So you see a declining trend. And if you look in our neighborhood and you look at the only country that actually stands out is Uganda. Uganda's manufacturing contribution to GDP around 2010 was single digit, 8.9%, and today it's 17.8%. It just tells you a story that on one hand, yes, we can argue that we have an issue that Kenya's pie is bigger. It's now a $130 billion economy. In real manufacturing terms, we haven't grown, but the number is really stagnant in terms of what it was because the service sector has grown and telecom sector has grown and other sectors have grown. And yes, there is some merit to that, but the fundamental premise, and if you look at all the developing countries in the world, all the emerging markets, each and every one of them, China, Egypt, South Africa, India, these are good manufacturing economies. You can see most of them are on double-digit manufacturing contribution to GDP, on average ranging between 15 being the average, and some countries like China, they've even hit at one time 30%, but they've come down on that. So when you start seeing a decline in trend, then you ask yourself the why question. What is going wrong? Why are we declining in our manufacturing contribution? And then you start realizing that, you know what, maybe our focus is changing. Maybe we are becoming an import economy. Maybe we are becoming a supermarket for imported goods. And maybe we need to relook at our entire trade agenda. And you know what, that you can see from the balance of trade between Kenya and the rest of the world and what we're importing and what we're selling. And I think you're aware about this, but on average, the import of goods has always been 10 billion difference between the exports of goods from Kenya and the imports of goods, hovering around the 10, 11 billion dollar mark. The only time that we saw a contraction to that number was during COVID. That number fell down to $8 billion. That means in that 1 year, we imported goods worth 14 billion and we exported goods worth 6 billion, and that difference was the balance of trade. And the rest of the time, we see that growing. Post-COVID, we saw a rebound factor. At that rebound factor, we saw imports go up to $18 billion, $21 billion now, and exports didn't grow to that same pace. And then you start asking yourself a question, are we just an import economy or are we an export economy? And then you start zeroing in. what in exports works, what doesn't work. An interesting story that I've used in the past, and the truth of the matter is we are the only country in the world where our exports went up in during COVID in 2021. I told government at the time, I gave them a warning like big public companies gave warning, a profit warning. I gave them a revenue warning that our $6 billion revenue out of Kenya is going to be $4.5 billion, and we're going to lose $1.5 billion. And why did I come up with that number? It was very simple. There were no flights leaving out of Kenya. For 3 to 4 months, Kenya was shut. We couldn't export anything. The rest of the world was shut during COVID. And yes, what do we sell? Lots of fresh vegetables, flowers, which is all flown by air. And there were no planes coming in and out. And to my total surprise, and to the surprise of many people that I've talked about, Kenya, with no export for 3 months, actually maintained their export revenue of $6 billion. And then you ask yourself again the why question. What went right? Normally we talk about what went wrong. Here I was asking what went right? What happened? How come our revenue has not dropped? And I realized that one commodity carried the day. That commodity was tea. And the exports of tea moved up from $800 million to $1.4 billion. And then I asked myself the second question, why tea? And I realized that, you know what? The whole world was on lockdown. Everybody was sitting at home. When you sit at home, what do? Drink more tea. So it helped. And that changed our tea business. So there are lots of good examples that we are a resilient economy in Kenya and in the region as well. So you can actually see those trend lines. Yes, in the deficit between imports and export at the moment, 11.8%. If you look at services, our exports, we're one of the highest exporter of services in the region. That's $5.5 billion. If you look at our diaspora income, last year it was $5.2 billion. So the deficit in goods is actually covered up by service export and diaspora remittances. So we're not in a bad space at this point in time. We have a fairly balanced book if you look at it in that context.
But, the root cause of this, in terms of our manufacturing sector and, same thing with Tanzania, not growing. What is prompting it that it's not growing? Is it the fiscal policies? Is it the monetary policies? Is it access to capital? Is it power? What is driving the non-competitiveness?
I think in one word, I would call it competitiveness. Because either you're world class or you're no class. There's nothing in between. And unfortunately, we are losing our global competitiveness. And if you look at the Kenya Association of Manufacturers, you look at the Kenya Private Sector Alliance, our mantra has now, over the last few years, has been that we want to be world class. We want to be globally competitive and not locally competitive and not regionally competitive. Because if you're just a regional player or a local player, it's only a matter of time when somebody takes your lunch away. And then if you go down into competitiveness, what are the drivers of competitiveness? And we've looked at it, and I've looked at it personally, and really there are only 5 drivers of competitiveness. Driver number 1, which demands in every value chain between 55 to 60% of the price of that commodity, that is the bill of materials, the raw materials. So are we buying raw materials at a higher price than the rest of the world to be uncompetitive? The answer is no. Raw materials are bought in this country and in the region at world price, so our bill of materials is rightly priced. That means 55% of the problem is sorted. So let's work on 45% of the problem. So what is 45% of the other drivers that drive competitiveness? Second driver is cost of labor, or I would call it productivity as a driver. I don't like calling it cost of labor because in China, the minimum wage is $400 and their per unit cost of production is lower than ours, and our minimum wage is $120. So we are not producing enough units in that second or in that minute to become competitive. So what do we need to do? I think we need to do a complete overhaul of our labor laws in this country. We need to relook at, are you getting paid by how many hours you sit on that seat, or are you getting paid by how many units you produce whilst you're sitting on that seat? So it's a fundamental discussion where we need to have a tripartite agreement with the unions, with COTU, with all the Ministry of Labor, and really to come up with a productivity index that will change that paradigm. That would drive, to me, in certain value chains about up to 15% or 18%, and in certain value chains even as low as 5%. So it depends what value chain you are. But so that takes you up to about 70% of your cost structure. Now the other 30%. I would like to mention the third driver of competitiveness is the cost of utilities. And I'm not calling it power, because power is not the only utility. Water is also a utility. Sewage is also a utility of doing business. And if you look at power as a cost of doing business, if you're a heavy, intensive power-driven company like the cement industry, textile industry, you'll actually realize at 22 US cents a kilowatt hour, you're not going to go very far with that cost. When the neighboring countries like Ethiopia is at 3 US cents a kilowatt hour, Uganda, their normal tariff is 12 US cents a kilowatt hour, and we are 22. Tanzania is around 13 US cents a kilowatt hour. And yes, with Uganda, they have actually grown their manufacturing sector and heavy industry because they've decided to give a subsidy to certain sectors. And the government pays the 7 US cents and you pay 5 US cents. So those are the type of incentives that I would call it the type of insulin jabs that you need to control your sugar if you are a diabetic patient. So the cost of utility is super important. Water, again, our cost of water is a $1.50 a cubic meter, very, very high. And the rest of the world is at 50%. It's like 75 cents. That is also a cost we need to look at. Then the fourth driver of competitiveness is the logistics. And in logistics, for every 4 containers that make their way into Kenya and in the region, 3 go back empty. It tells you the import-export scenario that we earlier on talked about. That means we are a net importing economy. We import more than we export. 3 containers are going back, and that's ridiculous. And that also tells you that you need to use the 3 idle containers to boost your export, even with a token fare, just diesel cost for the train or whatever it is, so that you can boost your exports. Your FOB, Mombasa and Nairobi should almost be the same because 3 containers are going back anyway. So logistics is a major cost. And then the last and the most important one also is the cost and tenor of capital, finance. We have a big disconnect of long-term finance, not available easily because most of the bonds are short-term bonds. So you get 3 to 5 year money, but for a large investment, if you need 10, 15-year money, you can't get it. And if you do get it, it'll be DFI money, and that DFI money will be more expensive than commercial banks. So the cost of funding and the risk perception of the continent, and you're borrowing at 500, 700 bibs above LIBOR, it just makes you uncompetitive. And you're competing with China and India, and I call them, because 40% or 45% of our imports come from 2 countries. And I call it Chindia, China and India combined. I mean, that tells you a whole story that these guys are super competitive. They're already on Red Bull. And how are you going to compete with them if you don't address your drivers of competitiveness? So there's a lot of work needs to be done. Otherwise, what is going on in the region right now with our trade agreements in the region, we have all these regional economic trading blocks. Of course, East African community, 310 million people, $330 billion economy is all duty-free in our region of East Africa. And we put COMESA last week with the COMESA conference in Nairobi. And there are 16 countries in COMESA. And they 660 million people, $1.6 trillion economy. It's all duty-free provided you add value in any one of these countries, including Egypt. So if the cost of power in Egypt is 5 US cents and the unit cost of production is lower and Egyptian goods are making their way into Kenya and they are taking shelf place of another local manufacturer, it tells you a story. And if you walk into any supermarket in Kenya, every week you go in there, you'll say 1 less spot for a Kenyan product and 1 extra spot for an Egyptian product. Today, Egypt controls 26.4% of entire COMESA trade. Kenya is number 2 now at 14%. At one time, we were number 1 within COMESA. So trade agreements without surveillance don't help because we need to be very, very sure, are those really genuinely made in Egypt or made in the trading partner country? Or are they just label production? That means good have come from China or India. And the only thing that's done is change of papers, certificate of origin is now renewed, and the revenue authority is losing a lot of money because they have no way to verify whether this is a genuine certificate of origin that allows duty-free imports or it's not. And I remember a case when I was the chair of the Kenya Association of Manufacturers, a whole paper sector in Kenya was actually dying. We had one big factory called Pen Paper, but it was actually collapsing because it could not compete with paper from Egypt. And I was the chair, and I asked myself, I don't see any trees in Egypt. It's largely a desert country. And how do they export so much paper and duty-free? And the factory was, of course, collapsing, Pen Paper. And we realized that, maybe we need to do a search on the certificate of origin. In those days, the rules of origin for made in Egypt was 45%. Today, it's 35% like the rest of COMESA countries. Everybody's at 35%. And then we talked to the customs authority at that time and said, guys, I think this sector is getting unfair competition and maybe we should look at the certificate of origin and go and check whether this really constitutes to 45% value addition. Unfortunately, the customs said, "Oh, we don't have any money. We have to send officers. How do we do that?" And as the chair, I took an executive decision in 2010, was it? And I said, "We will pay for your air tickets." And we sent 5 officers to Egypt, and they came back with their finding. The paper was coming from Italy. All Egypt was doing was cutting and packing it into rims of A4 photocopying paper that was making its way into Kenya duty free. And surely cutting and packing does not constitute 45% value addition. It was only like 3 or 4% value addition. But they were beating the system. And they actually created a whole fiasco in one sector. And there are so many other sectors that could be under harm if not surveillance is not done properly by the revenue authority.
You raised a very important question, is the rules around rules of origin itself. But there is also another disconnect that I see is invoicing hubs.
Correct.
If you reconcile, imports from China and India into Kenya, and then you look at the imports from UAE, and there's a mismatch because UAE doesn't really produce a lot, and it's not only UAE, there are other invoicing hubs. Mauritius is another invoicing hub. Okay?
Correct.
And how do we cure that? Because this is becoming a big issue, and it's more of a bigger issue when it's zero-rated goods. So machinery and other things where you import at a high price, claim investment deductions, don't pay taxes here, somebody else benefits.
Correct. I mean, it's an issue for sure. And, it's not so difficult. It's basically data sharing. If Kenyan exports to India, and I remember I traveled with the president to India 18 months ago or something.
We were together.
Yes, that's right. We were together. The Kenyan exports, I had prepared a whole speech for the president as the chair of the Kenyan exports that we're importing $2 billion of goods from India. And when I talked to my Indian counterparts, they said, no, we're exporting $3 billion to you. So there was $1 billion missing between the export revenue that India was showing and the import number that we were showing. And that was all, of course, under declaring in Dubai in this instance. And people would not pay the duty because they're all finished goods. That's 25% duty. So, imagine that's $250 million vanished, which would have been revenue for Kenya Revenue Authority, purely because the goods were grossly under-invoiced. And in India, they cannot under-invoice purely because they're looking for their export compensation. Their industries are getting export compensation. So they will no way want to have a lower export compensation amount. They will have to have a true export compensation amount. So goods were leaving India at $3 billion. They were making their way into Mombasa at $2 billion. $1 billion vanishing. Some guys are making some money, small money, maybe when paper changing was happening in some port somewhere in the Middle East, in Dubai in this instance. And and if you look at the UAE today, it's our second most important trading partner. And yet, like you rightly said, what do they really manufacture? They're just a big trading hub. And yes, they were trading themselves into glory.
So I think that's one area that, is a critical area to look at in terms of even our own revenue growth. But, you talked about the issue of the underlying aspects of manufacturing and what needs to be done. What is the role that, the private sector need to play in this growth? Is the private sector not able to play its role because of the challenges, or other things that the private sector can do to benefit, and grow their export market?
So you see, they've got to look at it in two ways. The private sector can obviously look within themselves. And I know for a fact, even at the Association of Manufacturers, we have a whole team that does Kaizen. And we actually have a Kaizen conference every year. We're looking internally. What is the continuous improvement that we can do in our factories, in our workplaces? What can we do differently so that we are really benchmarking global best practice? And that, I think, the private sector is doing and will continue to do. But what hurts the private sector is external forces, which is beyond their control. I mean, what happens outside your factory? And say if your factory is in Nakuru and you're transporting with a rail going to Mombasa, and that rail, the whole purpose of that rail that was built was to bring the cost of transport and logistics down. And yes, the government did respond to that. And yes, the government said Mombasa to Naivasha will be $800 a container, which was a very competitive rate. But that last mile from Naivasha to Nakuru was $600. So all in all, my cost was $1,400, which is what I was paying anyway on a truck. So what did we do wrong there is that we didn't fix the last mile connectivity. So there are similar examples that those last mile connectivities are not in our scope of work as private sector, even in the power sector. I know a lot of people are looking at how can we reduce that cost and trying to go into solar, but the technology is just not right for night production, for example. And if you look at your own bills of the power, you have a night rate and a day rate. And when you divide the units by the price that you're paying, it's exactly the same. So why is the bill confusing to an investor where the president has said that night rate, when the peak load is so low, we should give industry half price? But the whole methodology of working that half price is not really being implemented. So the left arm doesn't talk to the right arm. And in that process, you just become uncompetitive. And that pushes you into imports. Then you ask yourself the simple, stupid question. Am I wasting my time? Am I trying to swim upstream? What am I doing wrong? Why can't I compete? So there are lots of factors. Besides this is that tariff thing that I talked about, that all import value chains in this country are somehow or the other threatened by incorrect taxes or reduced taxes or convenient taxes based on how innovative the importer was. So you have uncustomed goods as well, which are thriving, and you can import anything at a price, like $7, $8 a kilo. They will not even ask you what's inside that box. And that's what you pay some of these logistics companies. But is that fair trading practice? So I think once we start asking ourselves, what is fair trading practice? What should we do differently? How can we level the playing field for everybody? That's when you'll start realizing there's a lot of external factors that actually hurt a real, strong, hard-working person who wants to make this thing work. And if you can't win them, then eventually the goal is, I can't beat them, let's join them. And I think so there's a big quagmire on what should I and what shouldn't I.
The East African community had done a manufacturing strategy for 20 years up to 2032. And there were three key pillars of that strategy. One was that manufacturing sector should contribute 25% of GDP. The exports from every country should be manufactured goods of 60%. And lastly, intra-regional trade should be 25% of imports. Okay, it's very ambitious targets. Today, I know Kenya or East Africa, the manufacturing sector to GDP is only 10%. Do you see us ever reaching those levels, or is it just a false dawn?
Well, let me put it this way. The intra-EAC trade, which was envisaged to be at 40%, the reality today, 25 years thereon, is at 15%. The intra-Africa trade, which is now 55 African countries, is again around 15%. And intra-COMESA trade, which I last looked at last week at the COMESA Business Forum, is 7.85%. And you ask yourself the simple question that intra-Africa trade is the lowest, or intra-regional trade is the lowest in the planet, and yet we expect to become a manufacturing economy. And if you look at, for example, intra-European trade, Europeans trading with Europeans in those 27 countries, it's 68%. You look at intra-Asia trade, Asians trading with Asians, it's at 45%. And if you look at intra-Americas trade, of course, that's a bit at the moment in a limbo with the USMCA being challenged and the Trump tariffs and this, that, and the other. But that also was very high, or hovering around that 38% intra-Americas trade. And when you look at intra-EAC, intra-Africa at 15%, then you ask yourself, something is not right here. And then we start looking at yourself and say, why are Africans not trading with Africans? And then you realize that, our entire infrastructure for the continent of Africa is built for extractive industries because of our colonial past. What does that mean? That means that you extract copper out of Zambia and the railway line will only take it to Dar es Salaam for it to go to China. But that's the infrastructure that has been built, that is our railway line I'm talking about. And if you look at all other industries, whether it is cotton or coffee or cocoa, all these cash crops, we export primary raw materials, we get very little value, we import finished goods, and then we ask ourselves, why is manufacturing industry not growing? Because fundamentally, we're number one, we don't even feel that regional integration is important. We don't even look at it that, so what if Uganda's got cotton and let them spin the yarn there, but we can make the fabric in Kenya and make the garments in Mombasa in our EPZs. We don't need an imported supply chain. I mean, we're doing really well in the apparel space at the moment. Last year we did $600 million to the US under AGOA. But $450 million of that money went to China. And the Americans are asking us a simple question that 70% of our export revenue ends up in China. You're not doing any value addition. Is it really helping Africa or is it helping China? And I don't think they're wrong in their thinking. So AGOA has now expired. We've got a moratorium for 1 year. And we're negotiating a bilateral because the current administration is looking at bilateral agreement as opposed to multilateral agreements. And I think there is a serious opportunity if we can start thinking different, if we can start thinking, so what if, the country next door or 3 countries down the continent have the raw material I'm looking for? How can I connect myself and bring that raw material, add value? And I love what President Museveni says. The problem with Africa is we're all pygmy economies and we are all trying to compete who's the taller pygmy. I think we need to change our mindset and realize, and look, united we stand, and if we can cooperate instead of compete, we'll be in a much better place. And we don't need to do everything what each other is doing. Let us look at your strength and capitalize on that. Look at my strength. And yes, if Kenya is a great apparel country, let Kenya make apparel. And if Uganda is a great textile country, let that so be it. But cooperate to compete and not to complement rather instead of competing.
That takes me to this issue of what do the governments need to do in East Africa to build an enabling environment to grow regional trade and grow manufacturing and value addition?
Well, the first thing the government needs to do is I think they need to look at each other as complementers of trade and not competition within trade. Unfortunately, every country, if you look at the TFTA that was signed between COMESA, SADC and EAC, tells you a story. 67% of our book was overnight retired to zero, which is capital goods and raw materials which were already at zero. We retired that into zero. And we are arguing about 33% of the book, which we are all manufacturing, but we are not looking at what is the core competence of your country as opposed to my country. For example, it would be natural that Zambia's core competence would be copper because they have it in their ground, right? But and it's okay if they make copper wire and send it to us. And then we can do vice versa. Tea, for example, is grown here, and we can add value on our tea and send it to Zambia. And if you look at the tariff book of the AFCTA, it's an e-tariff book. It's brilliantly designed. I must give them full marks. By 2030, we'll have a zero tariff within the continent. You can even today go into the e-tariff book and look at, I'm in Zambia, I want to export tea into South Africa, or I'm in Kenya, I want to export, what is the tariff line into South Africa? Currently, the duty on tea into South Africa is 200 cents a kilo, it's $2 a kilo, as opposed to their normal tariff, which is specific, 400 cents a kilo, which is $4 a kilo. That means Indian tea, Sri Lankan tea, and Chinese tea cannot compete with Kenyan tea because your tariff is half at the moment. And by 2030, it'll be zero. So there are serious opportunities once we start dismantling this tariff regime that within ourselves we can trade and within ourselves we can grow our business. Within ourselves we can add value. And I think that's the mantra. We should start looking at, and there's a map I saw the other day, and a map was showing clearly which commodities, cash crops can grow in which climatic conditions. And you don't need to work against nature, and what works for you, just naturally use it to your advantage and become an expert in that. And if you look at a classical example of tea, and I like giving this example a lot, is that we all drink English breakfast tea. Ashif, what is so English about English breakfast tea? There's not a single bush in England, and we still call it English breakfast tea. But you know why it's called English breakfast tea? It's because it's the British Raj. It was the UK, England controlling Kenya, Ceylon, or Sri Lanka now, India. And during that time, they decided they want to blend 3 regions of their community. We were part of their ecosystem, as I would call it. So they put 1 kilo Assam, 1 kilo Ceylon, and 1 kilo Kericho, and they called it English breakfast tea. I said, wow, that's brilliant. So why can't we do the same again? They said, no, we can't do the same again because the most important person in the room for English breakfast tea is Kenya. And I said, why? And they said, this is Kenyan tea gives us color and aroma, which Indian teas and Sri Lankan teas don't give us. So they're just a blending operation of three different teas, and we all call it English breakfast tea. And I tell you what, our $1.4 billion export of raw tea that I told you that day is Majani chai. If we convert that tea into English breakfast tea, ready mixed and ready for the market, that number moves to $7 billion. And I have a classical example for you. Kenya grows 500 million kilos of tea. Our export revenue is $1.4 billion. Sri Lanka grows 350 million kilos of tea. Their export revenue is $3.5 billion. So they grow 50% of our tea, or 60% of our tea, and their revenue is more than double. So it just tells you simple things can be done, and we can change the course of the land.
Just jumping into the East African community, and it started as a customs union. There is a plan to move it to a integrated monetary union. But then we have the Africa Continental Free Trade Area. And are there some roles of the East African community that will be taken over by the African group? And then what does East African community need to focus on? Or they both will still be relevant in the current circumstances?
Well, let's be honest. East African community was founded in the year 2000. 25 years on, we've progressed, but we haven't progressed enough. We've always moved forward and 3 steps and moved back 5 steps. We've always tended to expand the family as opposed to perfect the family on what the rules of engagement should be between the member states. So the obvious question is that how will this span into the African Continental Free Trade Agreement, which is the world's biggest economic trading bloc, if perfected? Yes, 55 countries. Yes, 1.4 billion people. Yes, $3.5 trillion economy. It's a game changer. It's a similar size economy to India, which is 1.4 billion people as well. It's just that the land mass is like 10 times bigger than India alone. So the opportunities can be 10 times bigger than India. So we're looking at a situation that what are these regional economic communities like East African community? How are they going to be positioned in tomorrow's Africa? So to my mind, there are 7 regional economic communities on the continent, and these are all building blocks into the Continental Free Trade Agreement. One being, of course, EAC, the other one being SADC, the third one being COMESA, ECOWAS, and so on and so forth. So we've got 7 regional economic communities that need to work. And then, of course, we can look at best practices. I think all of us have had different journeys. In fact, certain countries even exited ECOWAS the other day. ECOWAS is not even trading as it should have been. So by far, at this point in time, the East African community is working better than the rest. And maybe there could be some good leading examples, good practices that EAC can offer to the rest of the member states. But definitely, we need to start thinking differently. The lines on the continent were drawn in some meeting in Berlin in 1860-something. And if those lines were not there, you would just have one big continent of Africa. And if we are thinking economically, yes, we have been broken into language in 4 or 5 different languages and different commodities. But I think as long as the continents can think together and see that, look, what can we do in the infrastructure space? How can we work together? I don't need to go to Paris or Amsterdam to have a meeting in Casablanca, which is in Africa, or to Morocco for that matter. So there is an infrastructure gap that needs a lot of money. And once we can connect the dots, the rail, the road, the Cape to Cairo, which has been a dream for a long time, and you start joining the dots, you'll start to realize that, yes, there's a huge market within ourselves. And yes, we can become the factory of the world, because both India and China, their home domestic demands are so high today that they're now looking it's more profitable to sell domestic than to sell in export. Because if your per capita income goes up, you just start spending more, and that's a nature of life. So I think there are serious opportunities. We shouldn't close our eyes. There are challenging times, but we need to start together, all of us thinking that, yes, we can.
Just if you were to give final parting shots to the private sector and to grow, and how to leverage the human resources, the raw materials that we have, the agriculture produce that we have, what are the things that the private sector really needs to focus on to really take benefit of them?
Well, I think the first and foremost is that when you look at the landmass of Africa and you start seeing 55% of our land is arable, uncultivated land. that just tells you a story. There's a serious opportunity sitting in the agricultural space, like you mentioned. And then you start looking at what are we really selling to the rest of the world. And you'll realize, yes, besides our mineral wealth, which is the gold and other hard minerals that we have in our ground, including oil in certain countries on the continent, agriculture is a big space that we can play. And even the technology that we would need to grow some of these agriculture space will not be so different because, I mean, if you look at Dubai, you look at Israel, in the desert conditions, they grow, they are food sufficient. We, with our, as Kenya as a country, if you look at Kenya, we don't have water banks for our rains that come in. We don't do rain harvesting. If there's a drought, we get hit by severe food shortages. We should be thinking about how can we play this game differently, because the cost of doing business on the East African continent and especially on the equator are the lowest in the world. And I was told this by President Museveni. He said, there are only 3 countries in the world that are competitive. And I said, I don't understand, Your Excellency, what are you saying? He says, yes, Ecuador, Uganda, and Kenya. And I said, what does that mean? He said, we are all on the equator, and all 3 countries can do or produce with high altitude, which the rest of the world cannot do. And these 3 countries, they don't need to heat the air or cool the air, because the rest of the world, either in winter or summer, in winter you're heating the air, in summer you're cooling the air. So technically your cost of doing business should be the lowest in the world. Because the truth be told, even in this room, it's not air conditioned, but we're very comfortable with or without a jacket. So what I would like to say is, let's start looking at our core competence. Let's start looking at our strengths individually and then collectively. And then let's start looking at it that how can we complement each other and not compete with each other. And then start drawing a map for the continent. We don't need to sell 95% of Ghana's cocoa and bring back Nestle chocolates. We can ask Nestle, listen, we'll give you an incentive. Why can that chocolate be made in Accra and sell to the rest of the world? So I think we need to start having those candid discussions, and sometimes even difficult discussions that there might be an export on if that Lipton tea is not made in Mombasa, for example, as opposed to getting packed in Dubai. So I think these are things that we need to talk to our partners. I don't say there's anything wrong in engaging them, but we can even tell them the opportunity on the continent is far greater if you start looking at the continent and start adding value on the continent and start employing the people. To me, the most important thing, 1 in 4 people on planet Earth by 2050 will be African. And that is scary thought. Made an age of 19, what we saw in Kenya in 2014, the Gen Z problem, it was not a political Gen Z problem as it has been portrayed. It's a problem that the youth are craving for jobs. It is a joblessness problem. And imagine 1 in 4 people on this continent is African, 2.5 billion by 2050. And with AI and everything coming on, and there are no jobs, you can imagine that we will have a lot of disruption to social peace, which we don't want. So we need to start thinking different. How can we employ our people? How can we employ our youth? How can we be the next big thing so that we can have social peace? And that can be driven only by creating jobs and labor-intensive industries.
Yes, thank you very much for your time. It was really great having you.
Thank you.
Thank you, viewers, for joining us today on this second episode. I hope you find this useful. The whole series is, really meant to bring to you what is the real potential of East Africa and Africa, as a region, and how do we all contribute to it. If you like this, please share the link with others, and also give us your feedback so we can incorporate any of the topics that you want us to cover. But thank you very much and have a great day.